You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, president of Venable Park Investment Council Incorporated and the editor of the popular blog Juggling Dynamite. Welcome to the show, Danielle.
Hello, Jim.
On your blog, Juggling Dynamite, you mentioned subprime madness continues. Didn't we learn our lessons about crappy mortgage loans 7 years ago?
No, we didn't learn a thing. Well, I don't know. Some people in the general population hopefully remember this, but the incentives were all left in place for the investment banks to continue to package and sell junk and take fees. And so, the car manufacturers all wanted to pump out record amounts of vehicles, and so they have figured out all sorts of, creative ways to give cars to people who can't afford them, and then Wall Street's obliged them by packaging up that junk and selling it off to the pension funds and the, quote, investors of the world. And, the rating agencies are back at the same old tricks, calling it AAA and this sort of thing, when it's in fact subprime, highly questionable car loans that are paying, get this, like all that risk packaged into something that's yielding in some cases around 1%. Like, the mind boggles. What kind of thought process is a person going through to part with their capital with so much risk for so little upside? It's basically, it's this sense of, the way the incentives are in the financial system, it is in so many people's interest to just get people into various securities. Whether or not there's reasonable risk reward is nothing to do with their equation. It's just, the asset managers are mandated to be long, always holding lots of stuff. There's a bias against anyone holding any cash. They're supposed to look busy and brilliant, but actually it's really just a big Ponzi scheme. And people have been, throwing good money after bad all through the past few years to try and, central banks have been doing it to pump up asset values and keep the game going. And then you've got Wall Street and Bay Street and all over the world investment firms continuing to sell the same old nonsense. So it's, nothing's been learned in a systemic sort of way. And so the risks are exactly the same and higher in some cases than they were in 2008. If you look at the data for Canada, which I was writing about this week, Jim, and you and I have talked about it before, the data in Canada is a lot worse than it was in 2008. And here's the thing that I think is really significant in all this. People have been talking a lot about, the markets have been selling off in the past 3 weeks, and is that to do with, overseas conflict or the uprising in Hong Kong, or is it to do with the Ebola virus? And I've heard some people saying, well, because it was found in America this week, that's spooking the markets. I think here's the point. Anyone who thinks there's certainty in life is living in a dreamland to begin with. So this idea that markets hate uncertainty is absolute garbage. Real investors know that there's uncertainty every second of every day. The difference has to do with valuations. So if things are priced for perfection and for the, with needing sort of perfect conditions and record earnings to continue to go with no negative news, if that's the state of asset valuations, which it is today in just about everything, there is no buffer there to absorb any bad news. So if you look back at the last 4 pandemics, I was just looking at this. So there's been 4 major pandemics in the United States over the last century, and going back, starting with the Spanish flu in 1918, and you had Asian flu in the 50s, and all the way up to just recently you had the swine flu, as you remember, the outbreak in the United States. But that came, Jim, in April of 2009. If that rings a bell for you, that should it should ring a bell for most people as being very close to the bottom of the last equity cycle.
Yeah, I got sick with it, and I think my portfolio got sick at the same time.
Well, actually, your portfolio had already been dropping, you see, from December of '07 is when the bear market began in that case in the United States. Stocks had dropped already 55% by the time the swine flu outbreak hit in America in the spring of 2009. And so, although, so stocks began to rally from there. Now people will say, see, it doesn't matter that you have a pandemic threat because stocks still rally, but you have to always put it in context. So back to my original point is that once valuations have come off and been repriced so that everyone's expecting the worst, that's when you get upside surprise. That's when valuations tend to start expanding in the face of all this bad news. When you've got only good things expected and priced into the market like today, you have a lot of downside risk. And I think that's why, it's not because of Ebola, it's not because of Hong Kong, it's not because of any one of these things. It's because valuations have been stretched beyond reason the past couple of years as this whole QE ever expectation was built in and all the bears were shot and, only bullish people were left selling the story. And in the process, you have the U.S. dollar now strengthening. It has been, as we've said, for the past 3 years from 2011, and commodity complex getting crushed, and then, basically just risk being taken out of these overvalued asset markets, and that's putting on price pressure to the downside.
I interviewed a professor at Simon Fraser University 2 years ago, and he said, Jim, commodity prices will fall for the next 5 years. He just said, and he said China just can't, continue at 9% a year. He said it's impossible. Something's going to happen, and when they slow down, watch what happens to commodities.
Well, that's it, and it is a 7 to 10 year cycle, typically commodities. So once they start to break out to the upside, they tend to go for 7 to 10 years, and the credit bubble overlapping this time made them have that much more life. So they, went up that much further, and prices attracted a whole bunch of new production, as it always does. That's very typical of human behavior. So you get a bunch of excess capacity built into the system. And when prices are at the peak, that's when I'm back to my previous point. Everyone expects that trend to continue, and so they've only expectations of that style of growth continuing indefinitely into the future. And then, of course, that's when people find out they're swimming in supply and demand is turning down, and so that once that process happens, it takes another usually 7 to 10 years before prices begin to firm again. So we're from the peak in 8, we're 6 years in, but because there was a rebound into 11 again on the QE madness, you had more people ramping out supply even when the demand had already turned down. So you could arguably have weak commodity prices or flat, uninviting as an investment concept for perhaps the next even 10 years from here still. It might have elongated that consolidation phase this time with that extra bump in the between 8 and 11 in the QE stuff. So, it goes back to what have the central banks done in the past 3 years with all their promises, endless, liquidity. Well, all they've done is reach into the future, grab a bunch of growth that would have been possible 2 and 3 years out from in the future and pulled it back and spent it in, malinvestment and bad allocations of capital that are in more debt, which is going to just slow everything down. Back to the Canadian story with record levels of debt to disposable income, 164%, with some of the most overvalued real estate in the world today. Canadians, you don't need a bump up in interest rates. This is another statement I hear all the time, is that, interest rates aren't going to likely move up because we're in a slow growth environment, and because of that, they don't see any reason for stocks to retrench or for real estate prices to retrench, but you don't need a bump in rates. Once people have, staggering amounts of debt, all you need is, the reality is the debt service payments alone, even at record low rates, begins to slow your ability to consume. And that's happening all over the world right now. So you didn't have the wage growth. You had the slowest wage recovery in any recovery since the Second World War. It's anemic, hourly wage recovery in terms of the working people. All they did in the last few years was pile on some more debt to get through to now, and now they're at the end of what they can service on their income. So without a big bump up in wage growth, which we don't see because we're in a slowing growth environment in the world, without that bump up, they just can't service more debt. And now that's sort of a self-fulfilling thing because slower demand means that you're going to start losing jobs again, right? You're going to start seeing rationalization at companies trying to downsize costs again. And then that becomes a self-fulfilling thing because, again, these people have no seed corn. They have no money set away for a rainy day or to get them through the down cycle. So by this maniacal insistence on perpetual growth, which is what the central banks have tried to do and what corporations have tried to do, to make their earnings per share incrementally grow every single quarter, they have done destructive things like borrowing tons of money and buying back their own shares, which is, again, just a perpetuation of a Ponzi-like scheme. Since they're not paying people not paying their workers in wage growth, since they're not having top-line sales growth in this environment, this pattern that they've been doing of borrowing and buying back shares just means they have less money to invest in their business, and there's been no focus on growth of sales. So, you get boxed back into this corner of you didn't prepare properly for the slowdown phase, and you're over-levered, and the whole system is weakened by this incessant behavior.
Carmen isn't just an opera anymore. We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Danielle Park, president of Venable Park Investment Council Incorporated. Danielle, Carmen Segarra, a name that we're probably going to remember. She'll be historic. She isn't just blowing the whistle, she's singing. And it's all about how the Fed is in bed with Goldman Sachs. Can you maybe explain what this is all about?
Well, one of the things that has come about in the past little while, which is a relief or at least a positive development, is there's more and more people admitting that the Fed has never been there to protect the public or help the economy. The Fed has always been there to, number one, help their constituents, which is the banks themselves. And so this whole idea that regulators that are basically, under the thumb of the people or the companies they're supposed to be regulating are going to be hard on those companies is just a nonsense. So Carmen Segarra was, working for the Fed, hired to be one of the regulators, and in the process quickly saw her superiors kowtowing and, tiptoeing around these bank officials. And she said, wow, okay, I guess she was naive. She didn't realize that who was really calling the shots in that model. So then she recorded all these conversations to try and, get the word out to the public. And she indeed was, in fact, fired eventually for not agreeing to revise her assessments. So because her assessment was that Goldman Sachs, in fact, had no conflict of interest policy in place, which all firms are supposed to have, by the way, they actually didn't. And I know why they didn't, because once you put those thoughts to paper, once you put rules about what you can and cannot do in terms of conflict of interest on paper, then that can be a, something that people point to later to say, hey, you crossed the line or you broke your rules and that. So what they do is they don't put anything on paper so that they don't have to admit that they are breaching all these, rampantly breaching conflict of interest all over the place. So anyway, she released the tapes recently to media. There's a flurry of lawsuits going on. Again, she's put herself in a very precarious position, and more power to her because it's brave. Because, Goldman Sachs can afford the most lawyers of anyone on the planet, and they'll simply bury you and your counsel in lawsuits that'll bankrupt you and worse. So she has had the courage to release these tapes to the media to try and bring the public's attention to the fact that this is going on and that the conglomerates are not doing what they're supposed to be doing. They're not building up their capital buffers. They're not de-risking. In fact, they've ramped up the risk again, and it's all back to the reason, in the fall aftermath of '08, no one made any changes. No one forced any breakups. No one let anyone go bankrupt or fired any executives that had driven the bus into the ditch. And so all of that has just got even more garish the past six years. So then there was another good article. There's been several written recently about, the fact that, Justin Fox wrote one for the Harvard Business Review about why the Fed is so wimpy and just saying, hey, it's regulatory capture. Of course it is. The model was always set up to be so that the Fed could be this semi-governmental arm, but actually just so they can get access to Treasury and capital whenever needed for the banks. That was the whole point. So I was encouraged just because I know from experience of reading and learning all about these prior periods in history that until you get there's some lightning rod event typically that grasps the public's attention, that finally reveals this fraud and manipulation and, just patent dishonest behavior to the light of day. And usually you have to get that in some kind of a hearing. Now, we had a bunch of Senate hearings on the banking fiasco the past few years, but the senators have all been tiptoeing around, other than Elizabeth Warren, who's put a few straight questions to powers that be. But in this case, I'm just hoping one of these events is going to finally trigger. Now, they've called a new congressional hearing into what went on, in the Sergey case and the tapes and what's reflected there about Goldman Sachs. And, one of these days, something will have to happen where people are repulsed enough and it's embarrassing enough that politicians are forced to do something, at least in a token manner, that will, take away the powers or, have some of these executives fired, have some of them imprisoned. And I think that will be of huge deterrence value for a while going forward from there.
Well, in England, we saw 8 bank executives fired and their $5 million bonus removed for taking part in the LIBOR scandal, where not only were they fixing interest rates, they really were fixing interest rates.
Fixing everything, yeah.
Yeah.
I mean, Jamie Dimon of JP Morgan is a prime example of someone who was handsomely rewarded with a massive bonus for being able to, whittle the investigators down to take some, tuppence billions from them, which of course for everyone else would be crushing, but for institutions of this size, that the cost of doing business is tax deductible. It comes out of the cash flow available to shareholders. It doesn't dampen the executives that are doing all this. In fact, as Elizabeth Warren pointed out, Jamie Dimon got this huge bonus after he'd successfully negotiated settlements to all these very serious accusations. So as long as the system's like that, as long as it continues to reward all this horrible behavior, and as long as executives are not having to give back any compensation, of course there's no deterrence. In fact, all the incentives are still in place for them to continue doing all the horrific things they've been doing. So, yeah, it's I think the great equalizer is that I know prices cannot continue at bubble valuations indefinitely. I'm hopeful that the process of mean reversion has begun. There was talk of the ECB, again this morning, Mario Draghi was talking about his next QE-type promise, where he's talking about, don't worry, we'll buy more assets, we'll get a bunch of asset-backed securities, and we'll recycle toxic debt back onto the balance sheet of all these countries. Taxpayers will back up and take bad assets off the banks. But this is a very self-destructive cycle. We've seen it now so many places, and in the EU itself over the past 6 years, they've tried these things. the central bank in the U.S. and everywhere. And, what is the growth forecast for the world just keeps getting worse and worse, because that's what debt does, right? Debt just slows everything down. At very low levels of debt and leverage, when you add a bit, I've said this before, it's like an accelerant. It's great. At very low levels of debt, adding some definitely accelerates. Very high levels of debt, adding more just makes it worse. Just makes, the downside deeper and the recovery slower and longer to take place. And so I think we're past the end point of where those monetary elixirs have any impact. And so that's encouraging, because maybe now we'll get to some actual reform and actual cleaning out of the system, and we'll see how it goes.
Yeah, the little guy will get pounded again, and the other guys will just get bigger limousines.
Well, I actually think, the little guy's been pounded already very hard. If you look at the data, there's $2 trillion holes in pension funds all across the U.S., and Canada's in horrific shape. And, the only little guys that think they got away with anything the past few years are ones who have added on a bunch of debt. But if you take away jobs again, or if their wage growth can't keep up with some of the costs of the properties they're trying to maintain, that kind of thing, you'll find that they'll just let things go. Now, the people that have the money to lose this time are the ones who have taken advantage of these bubble prices in the past couple of years, but they have all the downside now. I think the little guys really don't have a lot of downside left, and that's kind of encouraging too. So, it's just we need some actual accountability put back into the system. Ponzi systems have been the go-to over the past few years, and
it seems England is the only place that has put measures in where now if a bank goes bankrupt in England, the CEO faces 3 years in prison. I mean, they've actually put a little bit of bite into the penalties now.
Yeah, well, and it isn't hard to do. We can certainly restructure incentives where people are paid in bonds of the company rather than equity of the company, so that they have an incentive to control the leverage on the balance sheet, right? If you're holding the debt of the company, you have a lot more sober take on the stability of the business. You don't want it to just incessantly grow at all costs so that you can cash out and leave the thing, emaciated. You want to actually build the quote fortress of its balance sheet. I think that's a no-brainer. And then, as we've talked about before, dividing off the sales arm from the banking conglomerate, getting the government out of it. There's no chance the government should be, back underwriting the risk takers. It's just been a disastrous plan. So we have to stop that for sure. And, another terrible thing, Jim, I just wanted to mention this because someone was telling me recently about how, certainly in Canada, and I suspect other places, there's this renewed interest in the sales force pushing borrowing to invest to regular people. So because the little guy has so little savings now, because he's been wiped out twice in the past 15 years with these big bubbles in stocks, and, they have this, it's called the Smith maneuver in sales talk, which is basically, you don't have any savings, that's fine, let's gut the equity in your home, take it in a line of credit, throw it in these equity-based products, the sales force gets big commissions, the mortgage broker gets paid, and the little guy's left with these toxic financial assets, all at ridiculous valuations, poised to drop by half. And at the same time, they're sitting in property, a house that's poised to drop potentially by a lot, and they're left with the debt. So this kind of unscrupulous sales practice is really, really toxic for families. And if anyone knows of anyone that's getting this pitch right now, just please read Juggling Dynamite, drop an email, get a second opinion, because it's just a really repugnant sales tool that's been used to harm people over and over. And the older one gets, and the longer, you just don't have the time to recover from this catastrophic type of advice. So I'm really trying to sound the whistle before the losses hit again.
Danielle, thank you very much for chatting with us.
Thank you.
My guest has been Danielle Park, president of Venable Park Investments Council Incorporated. Her website is jugglingdynamite.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. You can forward comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.